Now, Dan joins us, and he represents, of course, Global Co-Head of Commodities Research with Goldman Sachs. Dan, good morning. Thank you for joining us.
Yeah, pleasure. Thanks for having me.
Every morning we get up and we get to see something is happening on tariff, something is happening in terms of demand, something is happening in terms of what China would produce. In this kind of an environment where deglobalization is the new mantra, globalization is yesterday's data, how should one look at commodity cycles and especially copper?
Yeah, so we do think there is a role for commodities in portfolios. We do think that, however, you want to take a differentiated look at commodities. The outlook, for instance, for commodities such as copper and gold looks quite a bit firmer, given the demand backdrop where central banks are buying gold and where electrification requires very significant investments in copper. Then for some other commodities like the ferrous metals, where our view that the Chinese construction sector will decline is going to weigh on demand. So I think there's a role for commodities in portfolios as a hedge against inflation, as a hedge against policy uncertainty, in particular gold. But I think you want to take a differentiated approach because the demand backdrop varies, pretty significantly across the various commodities we cover.
Concern, obviously is it was steel, aluminum, now it's copper. What's going to be next? Which metal is Trump going to pick up next to, slap tariffs on?
Yes, I think he has already, announced or implemented tariffs on three of the key main metals, as you said, aluminum and steel, 25%, planned to go effective in early March. Now there's a Section 232 investigation to implement a potential tariff on copper. And I think why is the U.S. administration focused on tariffs on metals is a very interesting question. I think it has to do with the U.S. administration's agenda of promoting U.S. commodity dominance. What does U.S. commodity dominance mean? It means that the U.S., in the context of competition with China, wants to expand its trade surplus in oil and gas, promote energy exports of the U.S. broadly. It's a source of geopolitical power. And then on the metal side, where the U.S. is more dependent on imports, especially for some of the refined metal products or some of the critical minerals, in that area, I think the U.S. wants to expand its access to commodities and promote domestic production, promoting domestic production by trying to impose tariffs and by boosting domestic production. At the margin, and that's something we saw in 2018 when you also saw tariffs on steel and aluminum. We do expect on the metal side to see some boost to U.S. production, but the boost is unlikely to be very large. But I think it's all part of this bigger U.S. commodity dominance agenda.
But Dan, with the tariff war and the implications, the prices are expected to move a little lower with respect to the more supply into the global economy. Help us understand that. Where do you see the steel, aluminium and copper prices headed?
Yeah, so we are constructive on copper and on aluminium. On copper and for both commodities, we think that electrification and solid green demand, particularly in China, where stimulus is very much focused on electrifying and on green demand, is going to provide some support. We expect copper prices basically to rise above $11,000 per ton by 2026, on the back of strong electrification demand, on the back of China stimulus. And then based on the fact that following years of low investment, we'll need to see these high prices to continue to incentivize production in places like Chile. So that's the pretty attractive copper story, especially in 2026. And then on the aluminium side, you also have this solid green demand support. But I think what's unique about the aluminium market is that we expect China, which has imposed this cap on aluminium production, we expect that cap to be reached in 2026. China has driven the vast majority of growth in aluminium supply over the last 2 decades. We think in 2026, this will end. And so prices, in our view, will have to move higher to incentivize new marginal suppliers, for instance, from Indonesia or perhaps India, to continue to grow production and bring new supply supply to the market. So a constructive outlook for both base metals on the back of solid electrification demand and some supply challenges. In contrast with iron ore, where we still look for prices in double-digit territory, in the 90s dollars per ton. Why? The main challenge for iron ore is that we continue to expect China's construction demand to decline, as the Chinese property sector is still overbuilt. So a very differentiated outlook here across the industrial metals, with a preference for aluminium and copper.
Then now let's understand, where are copper prices headed? Now, assuming the tariffs are at play and copper production shifts to America or United States, but copper is not like AI, right? You'll have to identify a mine, you'll have to get the permissions, you'll have to put machines, you'll have to make the roads, and then only production will start. So by the time additional copper will hit the world, it'll take 3 to 5 years.
No, that's absolutely right. I think in 2018, when we did see tariffs on steel and aluminium, you did see a modest boost of production, but that's because you had some capacity offline that could be brought to the market, and you had an increase in the utilization rate of existing capacities. But if you have to boost supply by bringing new supply online in a long cycle supply commodity such as copper, this would take many years. There could be some room to provide permits to a copper mine in Arizona in particular. That's a possibility. But on our estimates, it would take until the early 2030s to see a meaningful supply contribution from that project. So in the short term, the impact on supply is likely going to be very limited. And so we think in the short term, we think the strong electrification demand outlook it will provide quite a lot of support to copper prices. Of course, the other big question for copper markets is what happens to the Chinese economy, what happens to U.S. tariffs on China, and what's sort of the broader macro backdrop and macro sentiment in global macro and commodity markets. And I would say that at the margin, over the last few weeks, markets have become a little less confident in the solid growth outlook that we have as our base case, on the back of some softer U.S. economic data and renewed concerns about potential tariffs.
All right, but Dan, also talk to us about where do you see the crude oil prices headed, because we're already seeing those at a 2-month low, and off late they have been consolidating, but what's the outlook?
Yes, I think indeed oil prices have edged down towards the lower end of our forecast range. Our forecast range for Brent is 70 to 85. We think this range works well both for OPEC countries and for the US. On the US side, we think the 70 to 85 range provides both affordability for US consumers, because you're sort of below the 85 per dollar threshold, which is psychologically important for the US consumer. But it's high enough, above roughly $70 per barrel, to incentivize supply from US shale. And we think that as part of the US commodity dominance agenda, making sure that US shale continues to grow is important and is part of the US administration's goal. And that I think we learned last year from OPEC that when prices were in the low 70s, OPEC tended to defend 70 as a floor. We expect that to continue to be the case. We expect the production cuts to be extended again through Q2, in early March. And then on the flip side, when Brent is in the low 80s last year, OPEC signaled to the markets, we're happy to bring some production back to the market. So we think we're still in that range. Currently, we're at the lower end of the range because I think the market is focused on downside risks to demand on the back of some softer US and global economic data, on the back of potentially downside risk to grow from tariffs. But if you look at the fundamental oil data, they're quite tight and quite solid. If I just look at global oil inventories, where I add up all the barrels that are stored in crude oil, refined products, they're at the lowest level since mid-2022. In mid-22, in July 22, the oil price averaged $112 per barrel. Not saying that the fair value of oil is in triple-digit territory, but our model suggests that based on inventory levels, the fair value of Brent is closer to $80 per barrel, as opposed to the 72, 73 price where we're currently trading. So we look for modest upside to $80 per barrel by Q2 as the market focuses again on oil market fundamentals and in particular inventory levels, which are quite low. And there is even some upside risk to our base case of $80 per barrel if you were to see a drop in, for instance, Iranian sanctioned supply. And overnight, we got news that Venezuela's license for U.S. producers to produce oil in Venezuela and export it to global markets may be revoked. And so this highlights, this supports our view that in the short term, the risks to sanction supply are skewed to the downside, and that could provide some upside to our base case of $80 per barrel for Q2.
Right. Dan, so good having you on the show and getting in all that perspective on what's really going on with the commodity complex.
Yeah, pleasure.
Okay, on that note.
If you like this video, then like, share and subscribe to ET Now.